broadcast. Welcome to the Zaner MarketCast, your one and only spot to keep up with all of the agricultural market news. My name is Joe Nikruto.
And I am Dan Hussey.
Here today with Dan Hussey. As usual, we're going to be taking a look at the grain and livestock markets, especially looking at corn and beans this week. Change is afoot. We've got some weekly price action that certainly caught our eye, and I'll bet it's caught yours as well. Dan, before we start, we want to let everybody know that if folks are interested in hearing about grain market movement and strategies daily, you can sign up for our Ag Hedge hotline hosted by expert market strategist Ted Seifert. Totally free. It gives you the chance to connect with us personally if you have any specific questions about the markets or ag commodities in general. If you're interested in learning more about price action and how to make price action work for you, it is a perfect way to take that first step. Link is in the description below to sign up for that. Again, totally free, zero commitment. Give us your information. We'll give you a shout and make sure that you're set up. No obligation, no cost. As always, keep in mind with everything we talk about here today that futures trading does involve risk of loss, and you want to make sure that this type of trading activity is suitable based on your individual risk profile. Dan, got to get to the white elephant in the room. You have received a bit of injury, but have interfaced with the medical community, and you may be on the mend. Is that right?
Yeah, I broke my foot running, right? I think we made people aware of that. I don't know. And then had surgery yesterday, right? Little outpatient surgery there. I got a little screw put in. I broke the fifth metatarsal, a Jones fracture for those that want to Google it and read about it. Yeah, bad blood flow, doesn't heal great. So doc was like 12 weeks of non-weight bearing, just in a cast, doing nothing. Or you can have surgery 2 weeks non-weight bearing, and then you're in a boot for another 3-4 after that. So I opted for the surgery.
So you were running to the liquor store. You were running to get ice cream.
You had to get cigarettes and
what was the running
liquor
part?
And booze. No, you're right. So I just in my normal training regimen, I was just out for a little 10K run. I was literally down 3-4 blocks or a half mile into it. Put my foot down. I don't know, my pinky kind of side of my toe foot got caught underneath me, rolled underneath. Thought I just rolled my ankle, but heard and felt a pop. And it was not my ankle. It was that outer bone, that fifth metatarsal or whatever. So not fun. Wouldn't wish it on anybody. It surprisingly, and fingers crossed here, because I'm still got 100% nerve block from yesterday's surgery still going on. So I don't feel a darn thing south of the knee. But, it hasn't been that bad so far. So fingers crossed.
We want to add a secondary disclaimer that any recommendations Dan may happen to make could be under the influence of nerve blocker. So you want to give all of this commentary an extra special fact check today, because Dan might still be a little woozy.
Sure.
Dan, I don't know, man. You get injured, but the market gets up and takes off. Interesting.
Yeah, not saying correlation does not equate to causation, but it is an interesting, conspiracy.
So I would say just without diving headlong into these numbers, you've had a pretty solid week across the board, right? We have not had much luck here as of late coming into these Friday episodes with positive price action. But this has got folks talking, right? I mean, a lot of calls, a lot of queries about, is this the bottom? Can we sustain this rally? And without putting out a spoiler alert, you maybe feel the answer is no.
Well, yeah, I think that there's definitely a reason to get behind this rally from a technical standpoint now. You're out above 18-day moving averages, multi-day reversals, all that good. There's lots of things to say, but it's really tough to build, I think, a really strong narrative here for how we get exceedingly bullish when you still have unknowns from China and other trade deals out there. We've got a really good looking crop across a lot of the country. There's spots poking up and everybody's talking about them. And that happens this time of year. And justifiably so. I think there's a need to build in some of that weather premium that a guy's talking about. Whether it's building on the weather premium or markets are just oversold, either way, you find a little bit of green shoots when shorts need to cover. We're certainly seeing that. And I think it's a welcome relief rally to start. Are we going to call it the bottom and a total turn for a seasonal low? Let's not get ahead of ourselves, right? These markets have been battered down at every chance that they've gotten. And I hate to say it, but this is still very reminiscent of the weather market rally I think we had in 2023. Corn got a significant bump that year and then sold off just as fast. So these, rallies can go 50 cents to $1 in a couple weeks and be completely unwound just as fast if the market decides to.
Is it possible that because of all these facts, all these technical facts and historical facts that you just mentioned, that we may have a bit of PTSD? And now that
right,
the market has rallied, we know that the kick to the head is probably right around the corner.
And it's probably a reason that this thing will go to
infinity. Yeah. Okay, I'll tell you, I wish I could disagree. Probably make for better commentary if I could disagree with any of the things you said. Certainly true, right? But technical fact on this weekly chart, you opened. Let's take a look here. Opened, and I'm using D's corn here. Opened 410.5. High was 430.25. Low 407.5 earlier in the week. Closed it at 427.75, just cents off the highs. Up 15.5 at D's corn on the week. Dan, I one of the things that I was thinking the other day when we were talking about this stuff with everybody else is that a lot of this move has been predicated on fund short covering. Right.
Mm-hmm.
And so market starts to move because the funds are buying and everybody kind of gets out of the way. For the first couple episodes there, they were covering rather aggressively and you've got higher price action because of that. Now, one thing that it makes me think is, what do the funds think they know? Here are the guys with access to the satellites. Here are guys with access to granular data about who has what, probably down to the county level in terms of corn left over. There is some talk of tight tassel, which is something I had yet. You learn something every week. The conditions out there because of lack of cooling degrees in the overnight, maybe not as great as everybody thinks. And I just wonder if maybe the funds are looking and saying, okay, we're down here in what has to be considered a value area and thinking their risk to reward. And here's another thing that I would say, at the risk of using too many words, I can't really think of too many times where you see funds buying the bottom, right? And being the catalyst for higher prices off of a new low. Much like I don't really remember the fund trader category selling heavily like they have been doing into new highs. You think that speaks to an evolving component within the fund trader category? The markets are just different. I mean, to me, I can't really remember technical trading systems that say, oh, new low, we need to cover, because they just don't do that, right?
Well, I mean, I think to your point, though, that could be the fund trader just beholden to their profit, right? The P&L is all they care about at the end of the day. It's the only thing they know for performance. So market's at a new extreme, you've got some profit. As a trader, from a risk management standpoint, it makes sense to take your gains in that type of environment or to start looking into it. But I also think that if you're foreshadowing or you start to get the inkling that there's weather or other things, reasons to cover, maybe they smell out that commercial demand down here that isn't always seen, that hides in exports, that hides in spreads, that hides in swap markets, other places where there's volume and participation from big buyers that are doing God's work, so to speak, for the really moving the economy. And I brought up a monthly chart here just to kind of show this idea of what I think on a chart. Have these big rallies and run-ups for multi-year reasons for grain prices to go higher. Then you have those deflationary periods where we humbly come back to reality and genuinely we prove to ourselves how good we are as producers across the country, right? As we build good stockpiles. And then we go into these periods where we just find support and go sideways as real commercial interests say, no, corn's cheap enough down here at 350, but it can't really get out of a 450 because of all the reasons that corn can't rally. I think we're going into one of those similar periods here. For the next longer period, I feel like can't really get below 4, but every time out above 5, we're probably going to get sold off and battered back down because we just don't have the carryouts, the tight balance sheets that justify corn going to $6, $7, $8 that we did in 21 through 23. And 23 was, if we go back here, I'll just throw up that daily continuation chart so we can go back and look at the rallies that I was talking about or alluding to earlier there too in July here. This is D's corn back in July. We had a great run up from June into July. And then right around the end of June, we sold off again. And I just remember that getting some PTSD over those rallies of how quickly it was a little earlier in the year. We're a little later now, a month later, but we were a 2-week period where corn ran from 6 to 7. You don't have to go that far back to find instances where the price action at this time of year gets rather volatile. And you can get these rallies that don't get sustained, but they can add enough premium to do some good selling to get that relief and take that pressure off, because nobody wants to. And I think we all agree, and even the market is kind of agreeing, we don't want to see corn with a 3 in front of it right now. And
it may just be too much demand, right? Like,
yeah, agreed,
as you alluded
right?
to, that commercial demand,
it's so cheap
demand,
down here.
Right.
To somebody, it's very cheap, right? Yeah.
We seem to be doing a good job of finding a home for that corn. China staying away in droves, really not sending any corn, as far as we know, to China. But we're doing a great job of getting this corn to the rest of the world. And so really great demand for corn, both domestically and overseas. And so hard to say, and just from looking at the chart, hard to keep corn below $4, but certainly hard to get it back up near 5
or below 4. You're right. You were right.
And the other thing that you mentioned here that folks should pay attention to is that if and when we see these rallies, we should also be mindful of the vicious nature of these sell-offs. 8 days to take away, right? We take the stairway up and the elevator down. And so guys should maybe have the finger on the trigger here, looking at some of these levels if we rally, looking at basis, and at least putting a plan together. And what I've been saying here is let's do some work so that we can look back in 3 months and say, oh, those were terrible sales if corn's trading 550. But if you look back and corn's trading 350, you're going to want to have got at least some stuff done here. And it's funny because I can't really seem to assign odds. Could we get to $5? Probably could. If you do have some sort of weather hiccup, this fund position today, I think they came in short 180,000 contracts. If they decide they have to cover more of that, we're probably going higher. And my suggestion would be that the distance between 427 and 3/4 and 457 or 467 and 3/4 is not as far as we think it is if the funds jump on the bid in a big way. So certainly reason for guys to pay attention and not be asleep at the switch. Polish up that combine all you want, but take a look at a screen from time to time, I guess is what I would say, huh?
Agreed. And there's plenty of resistance and price levels. We can throw those wish orders or those targets out there for guys looking to do sales. At this time,
50-day moving average.
Yeah, you got a whole cluster of them. The 200, 100 day up there around 445, the 55 day up around 436. And if you get out further above that, you had that cluster of all our other highs around that 470 to 480 area too. Not saying you can't get up there, but to give a guy an idea, like something I was looking at here, because we are out over that 18-day, that becomes a bull signal to me or a buying signal and a close today. Coming off of this reversal, if a guy's really looking for some reownership down here, I was looking at getting long futures using almost an at the money put for like September on December, something little less than time value, and you create basically a synthetic long. We're getting long the market via a finite or synthetic call. You're getting long the market with a finite risk here because that put is going to cover all the risk on that future if you're long it. And then to add another little piece to a leg to this strategy, also looking at selling a call up at 470 to 475, somewhere that offers a profit target for that future, helps pay for that put as well. You're completely covered. There's finite risk. And it gives you, the reason I like this over just buying a call, Joe, is because if we do break down and fall down to $4, that short call and that long put end up being legs that you can take profit on, restructure to then maybe work your way out of the futures later. But it gives you a leg that you're betting on partially being wrong about that reownership strategy. And we got to think about that, the risk in these situations. So I'm cautiously optimistic we're going to go higher, and we got legs towards the 450 to 470 area, but I also think you got to think the here and now might be for reownership ideas, but don't get too lost in that, because focusing on the sales when we're at the prices you want is, of course, the name of the game.
Now, the neat thing about that is it's like grabbing a falling knife, but with a really thick protective glove, right? So you're long the futures and you're buying the put underneath, which limits your downside risk. And then you're selling that call overhead to offset some of the cost of the put.
Yep.
And you're daring the market to come and see you at 475 where you
want to be called away.
Risk. Right.
You love to be called away.
You'll just stop making money. And that would be a pretty cool problem to have, to come from 427 to that 470 area and have to worry about managing this trade as a whole. Certainly a very nice toe hold, and probably even stronger than a toe hold position. I would say that that's a pretty nice outright position, because it gives you futures exposure from here all the way up to that 475. And that's kind of a beautiful thing.
And that's the thing I liked about that, right? In the reownership. I don't love reownership strategies where you're just melting time value away, because this is the type of environment where, that time value can just eat you up. And options calls, so you can they're great for finite risk, but if you don't get out of them when they're on the up and up, you can give back profits on a long call very quickly, because that premium can evaporate, and the futures are just as bad, right? If they drop on you, but
the thing I would
go down in value without the market moving, and that's the only thing the drawback, the only negatives you can say about a long options position.
The thing I would say about those long options is that this market has been under so much pressure for so long, is that those options are very inexpensive. 430, 480, and certainly not a recommendation. I know we're talking for educational purposes here about how to do this. If you haven't done options before and you're thinking about it, they're very rather inexpensive. 430 to 480, guy could put that up for near 11 cents. And then even with transaction costs, you're capturing
all in at 12 cents.
Yeah, 12, 13 cents. You think about what you can get for 13 cents out in the world there with a local elevator. Certainly that 11 cents is pretty well spent on a 430, 480 December call spread. You've got 430 as your line in the sand, and they start getting out over that 430, 440, they got to give you money. It's just a really nice way to protect sales that I think if we continue to rally, you're going to have to start making. And again, in this environment where the whole thing can change with one tweet or one thing that we had not seen coming, both of those strategies, I think, are marked with very quantifiable risk, right? And in this situation, I think that risk is really what we want to look in managing that risk well. We don't want to put more risk onto the risk that we already have, right?
Anytime you're speculating, right? Once you cross over into that realm of speculation, you want to make sure your risk is finite, because your capital isn't finite.
Right. And I think some of this, I view it more as insurance. I mean, I view this more as rally insurance as opposed to outright speculating. But we say potato, somebody says potato. That's fine. How about no beans? Same story here. That weekly chart says almost outside day up. We opened the week 10.03 in November beans. The high was 10.43 and a quarter. Low 9.98 and a quarter. Last trade I saw was 10.35 and three quarters, up a whopping 28 and a half. Funds are mildly short there, maybe less so. I'd be interested to see if they were potentially long after this week. But technically speaking, new lows early in the week, and then this higher price action that took out last week's high. And here we have closed just below last week's high, which to me is rather positive. What do we see?
Yeah, and got that little bit of a gap fill there, and we didn't mention that real quickly on the December corn chart too. Getting up, we still got that gap to fill up there at 432 and some change there. November beans, similar gap up around 1045, so didn't quite get the legs to get there this week. You wonder if they're not going to take a stab at trying to close that into early next week's trade, but you really want to see it break out over that level, because that's definitely been the start of that resistance zone, 1060 to 1080, that we've been unable to crack since February.
And you're absolutely right to mention that, because that is a very nice signpost. If we do not, if we cannot get out over that gap, that is going to be not a great deal.
Not good. Not good look.
Both both beans and corn.
Right.
Now, in beans, we did get into the gap, where with these corn, we did not quite get there. Beans got into the gap, don't appear to have it closed. High this week was what, 1043 and a quarter. Top of that gap
Just
is a low
shy.
of 1044 and a quarter. So we came very close before pulling back to end the week. But that, to me, glad that you brought that up. Very glad to be watching that gap.
With the downward sloping trend lines closing above these moving averages, that gap, it's just a level on the chart that screams to me, we want to get out over this. And then that really could open the door for that. That's where the short covering, I think, really starts, because you've got short buildup here going back into last year. So
the other thing is we made some
resistance
hay
there into 1080.
I think we made some hay in previous weeks about the possibility that this was a head and shoulders on the bean chart. And I can't remember about the corn, but one of our favorite patterns is head and shoulders, and more so a failed head and shoulders. If we do start to get out over that gap, if we do start to knock on the door of 1060, you begin to say, this is a head and shoulders pattern that has failed, and it speaks to much higher prices. And Dan, with the current narrative, I find that I can't quite get my mind around beans rallying to 1090. But if we start to take out some of these levels overhead, that's where we're headed. And conversely, if we fail at this gap and we fail to get out over 1060, your sub $10 bean price is back in play as well. And so quite a moment of high drama.
This is still just a giant bear flag. When you get out on that daily chart, this is a bear flag, right? We have traded down into a range, and you've got a very clear pennant and trend line support here. That back below $10, like Joe said, it opens the door for that break lower towards $9.59, right? But this range is holding. You get out over the gap over this trend line, you fail back. There's that head and shoulders, that left shoulder, head, right shoulder. The failure would be getting out above that gap and that 1060 figure, that right shoulder, breakout time, right? Completely opposite idea, right? We're going to $11 to $11.50 at that point. So in this consolidation, at some point, I think beans are going to want to break this, what is now basically a 60-cent range that Novi beans are trapped in.
And it certainly is freaking me out, the timing of this, right? And here we are in the middle, toward the tail end of July, and it's starting to look a lot like a weather market without the weather yet. And so here, all of a sudden, they sucked all that premium out, and now they're going to push it all back in. And you could be excused for thinking that there is something else afoot here, right? I've got my regular Zaner hat on with no foil in it today, but this is quite a move for this time of the year, I would think.
Yeah, and I think that's
under these conditions.
Absolutely. The age-old adage of don't sell a quiet market, I think, is kind of coming into the beans a little bit here. That's kind of, I feel like that's what the palpitation is growing. And yeah, you can almost feel it. And you brought up weather. Do we want to do wheat now, or do we got to give a second just to look at these weather?
We should probably talk about weather.
We're alluding to, right, we don't have the weather yet, but you look out, right? This temperature forecast for the next week, man, this is high 90s into the hundreds. So there's your heat units throughout the day. It doesn't cool off at night. That's troublesome. This is troublesome heat. It doesn't help also when you start to see these 6 to 10 and 8 to 14 day get dry. So you've got that below, except for North Dakota, Minnesota, Wisconsin. Congratulations. You guys might get some rain still. But the rest of the country is going to get really dry for the next 2 weeks, alongside some pretty big heat. This looks terrible. This next 10 to 14 days is going to be one of those heat domes, or as they say. That's what this looks like to me over the Midwest. We're no weathermen, but our meteorologists, but you look at these and that scares a guy, right? You go from what looks like a great crop to now these outlooks over the next 2 weeks. There's your shift, and a reason I think the market's building that premium back in, right? I will play devil's advocate here, right? Drought map. None of those places are in strong drought problems, right? But watch this map over the next 2 weeks and see how it develops and changes, right? We can maybe see that happen. And then also check out our rainfall mapping. The last week, this is the range, this is the last week of weather, got about an inch of rain everywhere. Just about everywhere got at least an inch to two. Many places got upwards of 3. So we've got a lot of good precipitation going back the last couple of weeks in the system, in the ground, right? But now the $1 million question is, how much does this weather suck all that out, right? So I'm watching my game plan now for the next week to give people an idea of how I'm watching the meteorology side of things. I'm going here to this mapping, watching every single day to see how the rain is falling, comparing that to the places that were maybe a little bit behind, which is okay, good part of Illinois and Indiana. But I have to admit, my part of Illinois looks pretty darn good. So this drought map is not an indication of where the problems probably are either. But I'm watching the weather maps, the temperature, and then the actual precipitation as it drops. And if we don't see more rain come during this hot and dry period, there's the justification for this weather market that we're seeing, right? So now is where the rubber hits the road, folks, and why people are paying attention. I mean, preaching to the choir, I think, on that note. But hey, had to be said. We had to give it a second. We'll see if it can ignite the funds and excite markets a little bit further.
September wheat, the opposite of excite, kind of the same pattern without all of the upside in corn and beans. Global harvest, domestic harvest, I think, increasing the possibility of available supplies. Wheat market reacting in kind by not really reacting. Opened the week at 543, the high 551.5, and September wheat low 532. Closed 546.25, up 1.25. No great shakes. I'm going to switch that.
Yeah.
Let's switch that to Dees just to make sure we didn't. It could be that December is. I should have checked that before we started, but same story in December.
It's the same story.
Yeah.
You're not missing anything. It's just a 20-cent difference. But literally, these charts, I'm flipping between them. They're moving in lockstep. There's no change there in what you
up 1.25 on the week. Up 12.75 today. If we jump out to the daily chart, the wheat market
right into that 18-day moving average at 567 to close. I'm almost not paying attention to that 18-day because we've gotten so choppy and sideways. We're not respecting it too much. But that 50 and 55-day, we're still below that. Still below that 100-day, up at 5. Still below that 200-day. That was massive rejection back in June. So I still think this is a downward trending market. We're still hunting out a low. Today smelled like short covering into the end of the week. I wouldn't be surprised if they came in next week and unwound all today. But okay, we got some clear lines in the sand there with our moving averages. Plus, I'd say a downward sloping trend line here that if it can break, you got a range all the way back up to $6. It can easily trade back up in just short covering for no other reason other than it just wants to do what it's been doing for the last 2 months.
Interesting move down here. Interesting move down here in wheat. If you look at the price action from the 13th of May, range expansion to the downside came all the way down to 520 in September. Not long thereafter, came off of those levels and then bounced around a bit as we have been doing. But as you came into the third week in June, range expansion to the upside, out over 582 for just 1 minute. Then immediate beat down back into this 530 area where we have kind of bounced around. And if you take out those two attempts at expanding this range, we've really been in a pretty tight 580 to 530 range.
Market's found its way back to 555.
Right.
Yeah.
So
it really has.
I don't know what to make of that other than to say that maybe there is just not enough concern about a lack of wheat and there is enough demand to keep wheat from falling back into the fours again. And so I guess we'll see.
I think there's something to be said for across the board on row crops. I think we're down into those levels where there's longer term value. Anyone you pick the random price of wheat any given year, we're down or corn or beans, we're down into prices that reflect, I think, real economic demand, which is why I think they're very hard. Wheat's kind of like a beach ball right now. It's very hard to push it underwater. It keeps popping back up, but it's got nothing to take it off the surface. It's not really going any higher than when it finds resistance either. So I think you're right. I think the market is certainly since May, you could say, has been in equilibrium, if you will. And all that we've seen here is price discovery of range expansion to either side and failure and reversion right back to the mean. So the market's very content right here supply and demand are clearly in some kind of equilibrium because we're not going anywhere. That's exactly what it means.
You look at if you look at August meal, even an attempt there this week, new lows and then higher close, not outside weak, but rejected this new low pretty handily. I mean, with meal, we really hate to, might be disingenuous to get all bulled up on meal the way that trend has been so pronounced, but a little bit of an arresting of the downward momentum, at least this week. August, we opened, I only mentioned meal because we got to talk about meal before we get to oil. Oil, more interesting chart. August meal, 270 open high, 274.30.
Yeah, I like that
low
we got out above that 18-day though.
In meal.
Yeah.
Low 264.50. The close was 274, up 370. And technical strength, you say?
I think it's a good technical close, but we did flip. Look at the daily RSI. It goes from being an oversold territory that right back to overbought now. You're out over the 18-day and you've got an open gap above you still, like the rest of the row crops. I think maybe you call it a dead cat bounce, but I think this is the bounce that gets you back to finding where resistance is. And I think that resistance could extend all the way back up to $2.90 to $3 for meal. Meal was in a sideways range for April, for the whole first part of the year, first half of the year. This capitulation, this breakdown kind of needed to happen. And so now that you built up, you had this huge period of accumulation. Now you've squeezed, you see this, you've seen their sweep of liquidity down to new lows. And then this to me though is like the first signs of, okay, we swept that liquidity, took it down to an extreme, and now that capitulation is starting to run it back the other way. I think the closeout over the 18-day with the gap above is the technical signal for now short covering to really ensue. And I think you're going to be right back to that 55-day, which is, by the way, been resistance pretty clearly here since March in a hurry. So that's kind of my play for next week. I actually, technically, this chart looks like a great reversal trade to me right now, but you want to see that commercial, or that you want to see a little bit of upside next week and then a bit of a pullback to kind of get into. But yeah, not to get too excited, but okay, if meal can find a bottom here and turn, what does that mean for the directionally for beans? Let's put it this way. What I'm getting at is meal broke from $3 down to $2.60. Soybeans couldn't drop for the life of them.
Nice trade too, because if you are not currently correct, you won't have to be wrong for long. You could get out of the way on that pretty quick.
You know where the line in the sand is here. You don't want to see it go to a new low. There's a 13 handle risk to the lows. But I think this is the type of trade on meal where you look at, like you said, things have gotten beat up. Call options are cheap. This is the type of trade that is great for grabbing a call option with finite risk, for a move back to 280 to $3, because you don't need the call option to go all the way back there to make it in the near term. But it's also a way of picking a falling knife a little bit. By all means, you've got a 4-day rally off of lows. It's not as much of a falling knife anymore as it was 4 days ago.
Right.
You have the first inkling of the first signs of a technical reversal have happened here, and that's what I want to call attention to.
Other thing here about the bean complex that is rather exciting. I'm looking at an August bean oil chart. We opened the week at 53.65. The high was 57.17. The low was 53.11. Closed that at 55.82, right near, not exactly near the highs, but certainly outside of the 3 previous weeks price action, almost outside of this whole weekly consolidated area. But Dan, if you look on that weekly chart, we did not fill a downside gap. We have been unable to even get close to filling that downside gap.
That gap and go, baby.
And here we are breaking out to the upside.
And that's the warning signal, right? This is an inverted warning signal to what is going on in corn and beans, right? They got that gap above that if they can't fill, this is the warning, is that the market would sell off in their case because, look, meal couldn't feel that gap and right back up to highs. They took it right back up in a gap up and go situation where you don't fill that gap. The warning here is for beans, if they can't fill this gap and they roll back over, they sweep the liquidity to the other side. And that's exactly what you saw in that happen in that bean oil after running away from that gap.
In this bean oil, you see a graphic representation of we're using more bean oil in the United States. And I don't have the numbers in front of me, but they're pretty big numbers, right? I mean,
graphical representation of what we have been looking and thinking and feeling about, right? For the biofuel
for a long
movement
time, right?
For a long time. And it's wow, now finally, okay. But look, right, this is an oil-driven rally right now. And the meal and oil charts are screaming that. It'll be interesting to see if meal can also get a bit under it, what the whole soybean complex will do.
Predicting the future always very difficult. But as you pull back on this chart, where do you see, so if we're moving bean oil now to a new higher equilibrium level, what does that speak to for the top end? I really wonder. Some pretty big changes for seed oil kind of across the board, wouldn't you say?
Yeah, just go out onto a daily chart and draw that trend line against the highs. You got a channel higher going on right now, in my opinion, in the bean oil, kind of forming up on this bigger time frame. This is a big rounding bottom, big cup and handle type reversal. I bet a betting man that I am not would say though that this kind of break out of this trend line and this curving bottom, next resistance I don't really see on this chart. This again, guys, folks, we're going out to a daily chart here. This is a really long time frame. We're not going to these light prices in a hurry, but there's no reason this chart doesn't technically go back up to 72 to 80, in my humble opinion. Just looking at, am I crazy for thinking that? No. You got a very nice long trend. You got the moving averages fanning out nicely. You've broken downward sloping resistance. There's going to be up and down to get there for sure, but I think that it's very reminiscent of how the chart kind of looked back here. Let's look at some other bottoms on that rounding formation. It kind of forms right as it starts to come up, and it can really accelerate. And there's got to be a reason for this. But this narrative for bean oil is on the back of a whole new avenue for demand, and this is going to be a new normal. This rally in bean oil, I think we can actually say this time it's different, or it should be. The market might be thinking it's different, and we're going to have to pay close attention to how it trades in correlation with energy products now rather than food and agriculture.
And as technicians, we look at what has happened in the past and extrapolate a bit. And so you would say reasonably 58 is going to be some resistance, because that's some previous business we did back in 2023. Nice little daily consolidation area there. And then
100%. You got
62 is the bottom of that big gap on this continuous chart. And I don't know why that's a gap, but it is. So you're going to say between 58 and 62, but under these circumstances, with this whole new setup for price discovery based on increased demand, you could blow right into that or blow right through that as this market goes to find the area where it's really supposed to be, right? And so not hard to get enthusiastic about what you see there, especially with us not being able to close that gap. To me, it doesn't take a lot of imagination to see that kind of continuing on, hopefully.
I agree entirely with you. And I think this is one of those charts maybe for the rest of the year to really pay attention to, because I think there could be some opportunity in a real way. This might be one of those next great commodity trends, and we're at just the start of it, right? It'll be something I think Joe and I will be talking about for some time here, because we've been waiting for this one. We've been waiting for this one for a while.
We've been showing up to all this stuff.
And by the way, folks, this is what a new normal looks like and feels like. There's definitely a reason to think that narrative could stick and continue on, and we'll continue to track that story as it develops.
How about feeder cattle?
Yeah, we got to talk to cattle a little bit this week, right?
This week,
stock.
We opened, and this is August feeder cattle. I think August is still good. Opened 325.30, 326.45 was the high, low 318.70, closed 324, down 132.5. Not surprised to see us take a bit of a break after last week's price action. We gotta take a breather here.
Pretty clear little range on the chart set up.
Fundamentally, I don't know what to make of this. Where are these? You got the Mexican border shut down still.
Cash prices haven't broken. So, until that happens, it's just the border's not open. You're just not, there's no way you can hurry up and find animals at this point. Right.
And I think the facts are telling you that
price rationing. Right. That's exactly where I was going to allude with it, was that it's not that it's a feeder. We always talk about feeders being the leaders, but fats have been the supportive, don't know you're not messing around market recently. That's where the weight has been carried in this rally.
Opened the week at 222.05. The high was 224.55, low 218.70. Closed 223.55, up 135.50 in the face of that feeder weakness. Not tremendous strength here. August contract getting a little long in the tooth. I think we run into first notice day here in about a week.
Yes, very close.
We could probably do the same exercise with October, and let's just to see October, same story. Open the week 219.60, high 221.17 and a half, low 216.15, close 219.82 and a half, up just 12. Not quite as strong as the August, but there's like a 14. There's a huge cash difference.
Yeah, it's double digits.
Yeah.
I was tracking it at 14.15 before. I did not check where we were today, but
14.73, something like that. It's pretty big. And so the thing that concerns me, Dan, about cattle fundamentally is this box beef has been rolling over in a pretty decent way. Prices not holding and getting cheaper. You look at the export numbers that came out, those were not great. You're beginning to see some of our marquee buyers moving to Brazil because of the tariff situation. And it will be interesting to see if that product doesn't have an impact. And it's hard to see where the product can have an impact on fats and feeders because there's no animals there. But if we're going to have a hard time finding a home for the product, how should that play out? And it's going to be very interesting to see.
Well, and that's where the real price rationing demand and squeezing the packing margins is going to occur, right? When you can't sell the end product, but you got to pay up for your input costs at record prices, that's not sustainable, right? So you're alluding to how that trickle down economics, right, or trickle up in economics affects this, right? If consumers aren't buying, the grocery store isn't selling, they're not buying from the meat packer, the packer isn't then buying from the feeder, and it goes on down. Then the feeders aren't being or the fats aren't being purchased, and the feeders aren't being purchased. So it takes a while for it to make its way through the economy, but it happens, and it will happen rather quickly. I guess once it gets going and once everybody cues in that the dance is over and the music has stopped and the fat lady has sung, the fat cow hasn't mooed here yet. And what we really do from a technical perspective here, feeders are a little bit better look at it. You had a little bit of a bull flag. You're just in a range here, down up to all-time highs, backed off a few handles, couldn't sell off, couldn't even go down to test the 18 days moving average. Feeders, interestingly enough, in this August contract have actually gone out of overbought conditions here in the RSI. I mean, there's room to the upside just on the technical standpoint alone. We don't have a top, in my opinion, yet in the cattle, based off of where we closed, how we held on to momentum this week. And I'm not saying that the top isn't around the corner or couldn't form quickly, but this is a weekend I wouldn't want to go home short without an option, without any protection above, because of how we're seeing them open.
Had the pleasure to sit across, dine with a wonderful farm family last week and sit across from young cattleman Blake. And we were talking about values and what folks were getting for things. And Dad said, Blake, what did you get for that last heifer you sold? And I can't remember the exact number because it just knocked me out of my chair, but it was well over $3,000. And so in that environment, I just wonder who is going to develop, who's doing the kind of development that we need to see increase this herd. And as long as that Mexican border remains closed and you're not launching cattle that have been eating U.S. corn just 100 miles from the border, waiting to find their way back into the U.S., as long as they're not coming in, I just don't see how these numbers can increase, right? And a lot of times cattle market
the only way they really are going to increase, right, is, and I think guys are going to feel comfortable increasing it with a good risk management strategy. When your input costs are so high, you need to immediately also lock your revenue streams. And that's something that we don't talk about enough in the row crops. We always talk about selling our revenue and locking in our revenue streams, but we don't talk about locking those input costs or locking that downside at times that you need to do as well. And when input costs are really high, as they were back with row crops back when they were $7, $8, right? We're talking record nitrogen costs for corn production. At that time, our narrative was, hey, when you're locking in those really record high input costs, you need to turn around and lock in your sales so that you know exactly what your profit margins are and you're not risking, it on both sides. Cattlemen need to be thinking about the same thing in this environment. If you run a feed, a cow-calf operation, whatever it is, if you are having to pay record input cost prices for your production, you need to be thinking about locking your revenue streams and your future sales prices via the board or insurance as well. because your margins are everything in this environment. They're the only thing that matter. In fact, cattle prices can keep going up. They may not. The song and dance could come to a close and we may fall apart, which is just all the more reason that you need to have that downside protected if you're going to be trying to increase that herd and grow in this type of environment.
For sure. For sure. Well said.
Just that PSA reminder to everybody out there, right? That there are solutions out there to give Joe and I a holler and talk to us about. We can walk you through and the conversation's free. We're happy to do it.
Think we missed anything?
What we're here for. No, I mean, we might have a question from our producer, Carter. What is your favorite flavor chip? Barbecue, sour cream, onion,
old what, ice cream?
No, chips.
Barbecue ice cream?
Oh, maybe you're inventing something new.
Right. That'd be great.
I mean, yeah, barbecue chips. I don't do any vinegar. I don't do the sour cream and onion. I think those are nasty. Yeah, I'm an old fashioned. I like the good old fashioned, just kettle cooked chip. I mean, I'm also a sucker for like Lay's ruffled chips, and I will go to town with those and some ranch dressing, but not like ranch dressing. You got to make it with sour cream, the Thousand Island package. Everyone knows what I'm talking about. We all had it at every party growing up, right? I can go to town on that, but
I think I got to agree with you. Just a plate full of regular chips will
man.
Do the trick, man, and every time.
I'm in it for the salt. Let's face it. Like it's a vehicle for salt. That's what I'm in it for. But yeah. Thanks for listening to the Zaner MarketCast today. If you need more because you just can't get enough of us, you can follow us on Facebook and on Facebook and LinkedIn at Zaner Ag Hedge and at Twitter at the Zaner Group. If you have a question you answered on the show, there is a link for you to do so in the description, or just follow the instructions and we'll get it answered for you on the air. Thanks again, and be sure to like, comment, and follow the podcast to not miss a beat, and we will be back with you as price action develops. Take care, everyone.